Let's get more on this now with Mark Humphrey-Jenner in Sydney. He's an Associate Professor of Finance at the University of New South Wales Business School. Welcome back to the programme, Mark. Now, the US has opened a probe into Fed Chair Powell. How much has that put the central bank's independence into question for investors?
Well, firstly, thanks for having me. And the probe into Jerome Powell is curious because it appears to be really over renovation expenses and his testimony in relation to them. It does look very much like it is a bit of a pretext for a prosecution to try to move Jerome Powell sideways or exert pressure on him to try to lower interest rates. Now, of course, to be clear, the $2.5 billion that's been reported about the renovation cost, that does look incredibly high. So it is important to probe that, but the timing and the context does look curious, and it does look like there is pressure being exerted. Now, in terms of the impact on Federal Reserve independence, even the perception that there's pressure is going to create problems. Because just think about it this way. Say we think about the next Federal Reserve chair, and Jerome Powell's term is not going to be renewed. So let's assume that that's going to come to an end very soon. So the next Federal Reserve chair is going to realize that he or she is going to go through a lot of time and personal expense having to fight any probe that comes up. And it might be President Trump this time, but it could be his successor next time. And it could be that maybe that next Federal Reserve chair is trying to lower interest rates, and hypothetically the government doesn't like that, or vice versa. You don't want the Federal Reserve chair to feel that they need to act along the president's commands, lest they bear a personal cost in litigation expenses. And while there, like I said, could be a valid question to answer about exactly whether the expenses really should be this high in the renovation, that's separate from a prosecution that does look like it might be pressure-driven.
Right, and that's also put pressure on the US dollar. If it continues to weaken, could that feed through into broader inflation trends?
Absolutely. So say, for example, we have pressure on Jerome Powell, and the market comes to believe that the Federal Reserve's independence is compromised. Well, that is significantly negative for the United States. Now, central bank independence is very important. It's very important because if you don't have an independent central bank, the president would try to coerce the central bank into lowering interest rates lower than they should be, so the president can go and procure any amount of spending that he or she wants at low interest rates. So it's a huge problem. Now, say, for example, that independence is compromised, then at least for the low end, for the short end of the yield curve, you might see perhaps a perception that interest rates will be lower. But over the longer term, we all know that inflation would pick back up, which is going to force the Federal Reserve at some point in the future to raise interest rates. And at some point in the future, the executive branch, so the president in the future, will need to acquiesce to that, lest inflation get out of control. So this would clearly impact fixed income markets as well, in addition to the United States dollar. And also we're seeing this feed through a little bit into equity prices. Now, again, at the moment, the probe has not progressed that much, but the perception that it might certainly is concerning to the market.
Right, and we're also seeing gold prices rising. It's hit a new record for the year. How much of that rising demand for safe havens is driven by current geopolitical risks?
Yes, certainly a lot of it will be. We've seen gold increase significantly in 2025. And indeed, for the past few years, we've had a relatively heightened geopolitical risk through a succession of various conflicts. The most recent ones, of course, involving Venezuela, also Iran, maybe Cuba, maybe Greenland, although the Cuba and Greenland ones appear to be less prescient than the Venezuela and Greenland ones at the moment. But nevertheless, we're seeing a few conflicts permeate. We're also seeing the fears about potential inflation, which again, too early to say whether that will really pick up. After all, pressure on the Federal Reserve right now won't cause inflation right now. It would be inflation expectations going forward. And that would also feed into gold prices. So all of these factors compound to help to boost gold prices and help boost effectively inflation hedges and also safe havens, which is what is helping to boost gold at the moment, the inflation and safe haven aspect of it.
Mark Humphrey-Jenner in Sydney, thank you for that analysis. We will be speaking to you again very soon.
Thanks so much for having me.